Hello and welcome to a brand new show of Market Makers. I'm Nikunj Dalmia. My guest on the show is Nilesh Shah of Envision Financials. Nilesh, what a delight to have you back on ET Now. Thank you for joining us. Our first show. So good to have you for the first show of FY13. Let's recap FY12. FY12 was a rough and a tough year for Indian markets. Benchmark indices lost 9% plus. How do you think FY13 is likely to pan out for Indian markets?
Well, FY13 also I think could be pretty much similar to what FY12 was, though of course the extent of variation in the indices could be very different. But I probably think that if not FY13 being a negative year, it could perhaps end up being a very flat year. And the hypothesis for that is basically stemming in from earnings. The fact is that earnings growth is still likely to be kind of flat or low single digit growth. I don't think earnings growth is going to be more than 10%. And I think in that kind of an environment, it's going to be hard to see kind of double-digit gains for the broader market index in FY13.
But do you think the key differentiator between FY12 and FY13 is expectations? When we started the year FY12, expectations were high. When we're starting the year FY13, there are virtually no expectations.
Yes, I clearly believe that expectations are virtually at a multi-year low. I've never seen expectations being so low. I think the extent of gloom and despondency is again at probably a 5-year high. But I think we have to also keep in mind that a lot of the variables which determine corporate growth, corporate profitability, still don't seem to be in control. They still continue to be very volatile, which is i.e. commodity prices still continue to be high, interest rates continue to be high. And I think in that kind of an environment, it's hard to imagine why earnings growth for corporate India as a basket would be significantly higher, or the trajectory of that is going to be very different in comparison to what we saw in FY12.
So crude is still the wild card?
Crude is the wild card, interest rates is the wild card, currency is the wild card. We're still seeing where crude is between $110, $120 a barrel. The currency is still at that 50 to 53 band. Interest rates are still kind of high. All these three things basically kind of leave an impact in terms of both margins, growth and cash flows. And I think the March quarter numbers are clearly an indication of that, where the revenue growth has kind of softened from about 22-23% to about 17-18% so far. But net profit growth, which was close to about 10% earlier, is now flat or marginally negative.
So do you worry about the course Q4 earnings have taken? Do you think this is some kind of an indicator that we should expect more slowdown in coming quarters?
Well, the biggest variable in all this is the investment cycle. I think for corporates as a basket or in aggregate basis, for them to see a meaningful earnings growth, I believe investment cycle has to pick up, because investment cycle has a huge multiplier effect on various sectors of the economy, and therefore the impact of that can be significant. I think we're very fortunate that the consumption cycle is still very strong, very robust, but the impact of a very strong consumption cycle is very limited, whereas the impact of a very strong investment cycle, I think, is significantly larger. That's something what India needs, that's something what corporate India needs. And I think when we clearly see the first sign of a reversal of the investment cycle, would it be, I think, right to say that I think our earnings growth trajectory will be back into double digits?
If I map the market movement, for last 3 months, markets have been bouncing in a range. And if I define the two signposts, it's 5100 on the downside, 5500 on the upside. When do you think we will snap out of the range?
Well, I clearly think that for that a lot of things have to change, in the sense that maybe globally, clearly things like Europe, etc., I think those have to kind of get into a more benign mode. Now that's something like asking for too much. So I think we'll kind of look back here, back home, maybe policy initiatives, maybe some correction in commodity prices, or some more clarity on policy issues. I think a combination of all of this, if they happen, whenever they happen, I think that would be a very, very strong dose for this market to come out of this range.
If I divide the world into two, Developed markets are making a comeback. US economic data of late has been strong, and US equities are at a multi-year high. If I look at Asian markets, Asian economies are slowing down, and Asian markets are, almost all of the major markets are at a 3-year low.
Yes, I think you clearly, it's a combination of two things. One is that the US economy is probably doing a little better than what the expectations were. I think corporates in America are, again, in general, doing very well. You leave aside the BFSI space in America, but I think corporate America is doing very well. And I think they're doing extremely well on the back of strong economic growth in emerging markets like India. And the fact is that they have underperformed for maybe 10 years or so. For 10 years, the Dow Jones hasn't done much. On the other hand, if you look at emerging markets like India, for example, I think the growth which is happening now is a lot less than the expectations or what the expectations have been over the years. And we're also coming out of strong outperformance over the last 10 years. And if you really look at it, over 10 years, probably Indian markets have delivered annualized returns in excess of 18%, whereas the US markets haven't delivered kind of any returns, or maybe it would probably be 1 to 2% returns. So I think we're clearly seeing a huge difference in performance, a huge gap of performance. And I think that's clearly where both the segments actually are coming out. And I think as long as the visibility of growth differential, I think, remains between US and India or US and emerging markets, I think till that point of time, the extent of outperformance will continue by developed markets or developed market equities like the US. I think the tipping point or the inflection point actually would be when the visibility of growth in emerging markets, I think, comes back. Till that does not happen, I think the extent of outperformance will continue by the developed equities.
Nilesh, over the years I've known you, you've always been a stock picker. So in this current market environment, where are you picking up your spots?
Well, we continue to like both the consumption and the agri space. Clearly yet the focus on infrastructure, while it is there, but we still think that the investment cycle still has got some time before the investment cycle really picks up. But we still continue to believe that both consumption and agriculture continue to offer secular growth opportunities. We clearly think that within consumption, again, there's a huge dichotomy. On one hand, we have the consumer staples or the non-discretionary spending oriented sectors or companies or businesses where valuations are very heady. Valuations are north of 30 to 35 times. On the other hand, we think that there are a lot of consumer companies which are more around discretionary spending, where clearly a lot of these companies have come off from their highs of 2010, 2011. They're probably off between 20 to 40% from their highs of the last 1 or 2 years. And we think that we are kind of trying to identify companies which we believe would be pretty robust and will continue to grow in high double digits over the next 3 to 5 years. And that continues to be our focus area. We're continuing to try and identify opportunities in that space.
So give us an example of what you like within the consumption space, where there is a bubble and where there is a bust.
Well, I think the businesses across the board in the consumption side, I don't see a bust there. I think the challenge is going to be valuations, or I'd say that the boom or the bust would be in terms of valuation. So I think right now there are a lot of companies which are today priced between 30 to 50 times, particularly on the non-discretionary spending side. Now, if right now the assumption is that these companies will keep growing at about 30 to 40%, I think the day they give indications or the market realizes that growth of 30-40% is not sustainable, and you'd probably see growth of more like 10 to 15% for a few quarters or maybe even a couple of years, you could actually see the valuations kind of getting busted. And I wouldn't say that that's not possible. It's quite possible, and that's something which could happen over the course of next few quarters.
So stocks like Nestle, HUL, ITC, are they trading at bubble levels?
I would tend to think so. I think when you have stocks trading at 40 times, 45 times, I'd clearly say that these valuations are clearly not sustainable. They could sustain for a few more quarters, and I think they have a good chance to sustain those valuations till the broader economy does not pick up strongly, till the investment cycle does not pick up very, very strongly. And if you really look at it now, everything seems to be going right for these companies. I think a year and a half back, I think it was a very different situation where valuations were a lot more attractive, and the best was yet to come for these companies. Today, if you really look at it, they are having the best of all worlds. There is volume growth, there is the ability to pass on inflated costs, there is the ability to hike prices, their ability to graduate towards premiumization, and I think all these things are virtually happening simultaneously. And I think all of these levers will not always play out every week or every month or every quarter or every year. And I think the day one or two levers give way, you'd probably see the valuations not expand further in the first stage, and maybe in the second stage get back to their long-term averages.